Hey, this is Sasha. Thanks for joining me in today's video. What I want to share with you today is just trading call options, single call options. We're going to do it on Facebook just because that's the one I want to choose today. And we're going to take a look at how you might set up and structure a trade. So let's take a look at this and I'll share with you some quick insight. All right, so before we get started, keep in mind that when you trade single call options or just single options, you create a lot of risk in the sense of, hey, you've got to choose a market direction, it's got to move, and not to mention you've got big time decay that works against you. This is not the normal way that you would want to trade. This is more like in your speculative portfolio. Maybe let's say 5% of your portfolio, 2% of your portfolio, kind of like the day trading money that you normally have. So if you have a $10,000 account, maybe you'll use, $500 or $700 for this kind of stuff. So if you really want to learn the proper approach to trading options, I would definitely check out the Trader's Fly site. Go to the Start Here Options 101. There's a ton of freebies you could download. Check out some of the great courses that we have. Some are 20 hours long. Here's the Options Mastery one we just released not long ago in the Diagonal series. And you can also book a one-on-one session as well with me if you want to work together. So anyways, let's take a look at this as how we might approach kind of getting a single call on a stock. So what's going on here is, people start out with looking at, let's say, the daily graph or maybe even the weekly, the monthly. And what they'll do is they'll go ahead and you say, okay, well, I'm now interested in this stock. Whatever your reason is, right? It could be fundamentals, it could be technicals, it could be because the sky is out today and it's not raining. Whatever the reason is, right? My point is to illustrate the example for you. And you go ahead and you start looking at these charts and you say, hey, today it's looking like it's a good day. So you're going and you're trying to say, okay, well, where do I want to go ahead and place the trade? So the question you have to determine is how much time you need and where do you expect and anticipate that it'll go. Let's say we go ahead and we anticipate things will go to the 240. Right now, the stock price is at 234. If we think it's going to go to the 240, I may only need to get to 240. Now, granted, the closer you get to the current price, the more expensive the option premium will be. So if I go ahead and get very, very close to that price, it'll be more expensive. Whereas if I go further out, it'll be less expensive. So for example, something around let's go to the hourly chart. Something around 250 will be less expensive. In the same way that the longer the duration, the more time I have on my side, like let's say I go to 198 days away, it's also more expensive because there's more time premium built in. If I only go 23 days away, there's less time premium. So this costs less, but a faster theta, which means the amount of value that option decays is a lot faster against me. This one, it costs more, meaning I also have more vega, but less theta and time decay problem. So basically options decay and they lose value over time. And when you do these kinds of things and you start looking at this, what goes on is that you're really working against time when you're buying single call options. Again, keep in mind, this is not the smart and proper way to look at trading most of your money in account. This is for that speculative part. And I can't emphasize that enough because what you'll have people do is if they got a $20,000 account, they go ahead and put $19,000 in trades like this. That's not the smart approach. Again, check out the Start Here pages, check out the Getting Started stuff, check out the courses. Look at what we've got. It's much more in depth than just doing this. But let's say I go out and I want to go 51 days. I choose this because hey, it's not as fast time decay, but it's also not as expensive, right? If I go 200 days, maybe you pay too much. If I go 16 days, the time decay works against you. So choosing somewhere in the middle, 50 days, might be the approach you might look at. So here, as we go into this, what I want to do now is let's go ahead and choose our call option. So I have a few choices here. Here's my strike right down the middle. I've got 52.5, 55, 57, 60. And you can see the prices here. So here's my prices. So if I go to the 60, I only pay $1.67, but that means it's got to go a little further than if I pay something for 310. So I pay double the price, but it doesn't have to go as far. And basically, you've got a lot more movement here that can happen. And what this delta represents is stock equivalent. So think of this as 36 shares that you're getting. This is like 22 shares. This is like 17 shares. This is like 6 shares. So each one of these has a certain amount of shares in a way. And if you want a stock equivalent, like something way deep in the money, getting 99 is very close to stock equivalent. So let me just show you that example. If you look at the delta, and let's do Facebook, because that's what we're talking about. And here is our delta. Let's say I go to the 170, which is close to the stock equivalent. I don't want to go too deep because it'll be less liquid. But here's our stock equivalent. So what happens here is, as the stock price goes up, you basically have about 100 shares. So you got 94 shares. That's the delta of 94. If I have 100 shares and we analyze the trade here, you can see 100 shares of stock will give me a delta of 100. And what does that mean? That means every $1 move that stock goes up, I make $100 because I got 100 shares. So if you look at this, I've got 100 shares checked here. So there's my check, got 100 shares on Facebook. There's the stock. There's my delta, profit and loss at basically 0. Let's say this thing goes up $1. Well, I move that price slice, goes up $1. How much do you make? You make about $100, right? We were down 2, and then you make your 100. So there you go. You got you make $100. Let's say it goes up 3. Well, think of it. 3 times 100, you make about $300, right? So here, there it is, $300. It went up $3 from where you started the position. Now, if you're dealing with an option, right here, this is the same concept. So I'm starting a little bit more down right here, $55 down. So let me go ahead and see if I can go ahead and make it a little more normal. There it is. Let's say we're starting at kind of 0. And we've got a delta of almost 100, so it's close to stock equivalent. If it goes up $1, look at that. Same thing. You make about $100. It goes up $3. What do you think? About 300. Now, this one says 280. Why is that? Well, the delta here keeps changing based on the gamma, and you're also going to have time decay also that'll kick in. So there's a little curvature to this line. So as you look to move this, notice that delta will actually change. Okay, so notice my delta right here is changing. Whereas when you do a stock equivalent, it is not changing. So I can move this, you can see it doesn't change, it's a linear line. Whereas with the option, it is a curved line, so that will change. And but nevertheless, it's close to stock equivalent when you do something like this. So if I was to go ahead and get kind of this option contract here, reset it, and you think, hey, Facebook's going to go up, well, I'll go ahead and go out in duration. Here you can see it's actually pulling back a little bit. Maybe you'd want to wait. But I'll go ahead and just go ahead and get into this. So let me try and get filled at a lower price here. Go ahead and let's see, put it in this account right here. We'll see if we can get, let's do 2 contracts, which means controlling 200 shares. Go ahead, boom, you get filled, and that was pretty quick. So now what you'll be able to see is I've got Facebook right here. I've got 2 call contracts, 51 days out, and you'll see it starting, it's going to start to wiggle. So how do I make money on this? Well, you make money on this when the stock goes up, because your delta is kind of your biggest item. Why is it 189 now instead of 90? Well, I got 2 contracts. Each one is worth about 95 delta. So you could do something like this where your stock equivalent, that's one approach, but it is more expensive because how much cash and capital did that cost? That cost about $13,000. So it's quite a bit of cash to put up, but it's very close to stock equivalent compared to the stock, or actually getting the stock, which is even more. I'll go ahead and sell out of this, and I'll show you kind of the other approach that people take. This approach that I just showed you is called deep in the money buying call contracts, and it mimics the stock. If I go ahead and do the 51 days and I go out of the money, it'll be a lot less expensive. So here I am. If I go to the 250, okay, you can see that's $7.70. If I go to the 280, it's only $1.88. So what's the trade-off here? Well, one is cheaper, but the other one, it's further away. So you have to balance now the amount of money you want to go ahead and put up versus the distance the stock has to travel. So just to show you an example, here's one. Let's do a single, analyze the trade at the 290. And then we'll analyze another one at the 250. Okay, so here's what this looks like and what it really means. If I do one that's at 290, I've got a theta of -5. That means every day I lose $5. Now that contract only cost me $157. Now if the stock does go to and explodes, I could make a lot of money, right? Think about it. You're putting up $157 to maybe make, I don't know, $1,000. So 10 times your money. That's amazing. But the problem is you lose $5 every single day. So, and your chance of success is it's got to move pretty far, right? It's got to move to 290 and beyond. If you look at the 250 level, you're a little closer. So now this stock only has to go kind of to the 250, but it's more expensive. Look, this one costs $7.85. Okay, your delta here is 35. So think of this as 35 shares equivalent. This one is only 8 shares equivalent. So it's got to make a bigger move. You got less shares in a way the further out you go. So here what you could do is go ahead and look at the 250, and now it can move and kind of ramp up. So I could go ahead and confirm and send that in. And now, boom, I'm in the stock, I'm in the trade, but it's a little closer. The problem with this is I've got a 12 theta. That means every day I'm losing $12. Every day I'm losing $12. Whereas this trade, I only lose $5 a day. Why is that? Well, it's further out, and what happens is there's just less money and premium in there. So you can't lose as much that quickly because then it just in the same amount of days, right? Because otherwise, if it was losing $12 a day, you'd be done in 10 days. But this trade has like 50 days to go. Here, you're losing $12 a day because there's more premium in it. So this is a $780 trade. But if it ramps up and goes to, like, let's look at this example. If it goes to 290, in this case, you'd make 3,614 on the one we just put on. This one, if it goes to 290, you'd make 1,607. So you make way more on the one you put up more premium. Think about it. More risk, more reward, right? More delta. It's kind of like having more stock. That's what it means. And this is how you would look at trading these call options. And let me get rid of this other trade. And now we've got this one contract. I've got a 250 call. And you can see right now, profit and loss for the open, yeah, it's up a penny, down $5, up $5. But what you got to account for is if this stands still, you're still losing $12 a day. So you need to be moving up at least, in a way you could think of it, it's got to move up every day, make you $12. Or you could say, well, eventually it has to make that up because let's say it just stands still here for, let me reset this. Let's go to 1 day, 2 day, 3 day, 4 day, 5 day, 6 day, 7 day. 7 days it stands still, you're down about $100. Well, in that case, it's got to move quite a bit on one of the future days. And then, hey, that $100 that you paid in time premium and it moves up and you made $700, it's not a big thing, as you can see. So really, it's just balancing these concepts out. That's how you look at buying call contracts. And you can see if the stock does keep moving in your favor, yeah, these profits can start to rack up. And it really just depends here on the price movement, because this trade is set up for a directional move. And as long as it keeps going in that direction, we keep making money, in our case, about 35 shares worth. So $35 for every $1 move up in the stock. But we do lose about $12 when that stock stands still. So there you go. You can see we're up about $12 now on the trade. Keeps moving, and so on. I'm just going to go ahead and close it out. To close it out, you right click, analyze closing trade, sell. You can get out of that position, and boom, and then you're out. And there you go. So now you went ahead and get filled on Facebook. So it really just, as you look at these things, remember you have to account for the bid-ask spread. So even in this case and in this trade situation, you can see I went ahead and I've got a -5 for the day, and that's possibly because of the bid-ask spread. Just getting in and out of trades, it costs money, not on the commission side, but it costs money on, hey, sometimes there's a slippage cost. So be a little more cautious there. So you need to make enough premium and money to make that work, and also be a little more cautious about the theta that you're going to be losing on these call contracts. And finally, last reminder that, hey, this is not the approach to trade with big money on. In the case of big money, what's big money to you? Meaning the percentage of your account size. So I wouldn't do this with more than 5 or 10% of my account, because you're choosing a direction and you're losing time value every single day. It's not the wisest approach. That's why I would say go check out some of the things we have, which really is a smarter way to trade options, and some of the other videos. But I'll share these concepts with you so you get a basic idea and insight of how maybe you get started with trading call options and how call options work. So I hope this gives you kind of an introduction of the way that people use them to make money. But, you know, it's just an overview. It's just a bigger picture guide. So anyways, thank you so much for joining me. Feel free to check out some of those freebies I mentioned by clicking the link over here, or subscribe to the channel if you're brand new. And feel free to submit any questions, concerns, and comments that you have on our website. You can even submit one by voice or even by video. And that way, maybe I can answer your question here on the channel. Thanks again, and I will see you next time.